So you've finally found that perfect home. Now, all that's left to do is pay for it. Easy enough, right? Maybe not as easy as you'd think. To help you learn the ins and outs of paying for your home, let's bring Adam back. Hey, Adam. At what stage of the home buying process should people start looking for a mortgage?
Seeking out a mortgage in the early stages of your home search can help you avoid many of the pitfalls that befall first-time buyers. Beginning these conversations with lenders or mortgage brokers now can also give you a good idea of your budget, aka the amount of money you can borrow based on your finances. When it comes to determining your budget, you have two options. One is a mortgage pre-qualification letter, which is based on a preliminary check of your credit score. A pre-qual letter signals to sellers that you're creditworthy, but it isn't the final say. Still, in a buyer's market where sellers outnumber buyers, a pre-qualification letter should be plenty. However, in a competitive seller's market, it makes sense to get a mortgage pre-approval instead. This process goes beyond a cursory credit check and delves into your income, your debts, and your assets. The goal with the pre-approval is to present yourself as a serious buyer. If you're competing against other bidders, a mortgage approval assures the seller that you're able to close the deal. This document also tells the seller how much you've been approved to borrow.
As a note, people are often pre-approved for much more than they can realistically afford. Check out our budgeting course for help with figuring out what mortgage payment really fits in with all your other expenses. Whether you get pre-qualified or pre-approved, every buyer has one thing in common. They're trying to get the best deal possible. We've talked about the importance of comparing rates, but what other factors determine the rate that a borrower is eligible for?
Scoring the best rate requires stellar credit and a solid financial picture. The lowest rates generally go to borrowers with credit scores of 740 and higher. If you're on the cusp, take a few steps to boost your score, like paying your bills promptly and keeping your credit card balances under about a quarter of your total line of credit. You can still get a mortgage if your credit score is below 740. But the rate or fees will be higher. While your credit score looms large, other factors will affect your total mortgage payment too. For instance, a down payment of 20% or more will let you avoid private mortgage insurance, the add-on that protects the lender in case you default. You should also ask possible lenders if they offer no closing cost mortgages. This option allows you to either roll closing costs into your principal and pay them off over the life of your mortgage, or pay them back via a higher interest rate. This is a good option for home buyers who are worried about costly upfront payments. You'll still have to pay the fees, but you can avoid paying them all at once.
Now, let's talk about where to find these mortgage lenders. I might be a little biased, but going to Bankrate.com and comparing rates is my top recommended option. But what if your real estate agent recommends a lender? Should you still shop around?
In most cases, realtors will suggest the names of a couple of loan officers or mortgage brokers. Remember that you're under no obligation to use their recommendations, and in fact, in many instances, you shouldn't. While retail lenders offer the benefit of being able to meet in person, it comes at a price, a higher rate. In today's world of virtual meetings and digital applications, face-to-face interactions with your lender simply aren't necessary. If you're looking to save, shop digital solutions. You'll still get the personal attention of a loan officer, but you won't pay for things like rent and coffee that brick-and-mortar lenders have to charge for. This is one of the reasons you should always visit Bankrate to compare rates versus going directly with the lender, even one that a realtor or friend recommends. Bankrate brings you accurate rates from dozens of top lenders, allowing you to scan your options and choose the rate that saves you the most amount of money. By compiling all of these rates, we force transparency from lenders and motivate them to compete for your business. It's why on Bankrate, you'll consistently find rates that are lower than the national average, sometimes by as much as 0.25%. What does that mean for your wallet? Let's say you purchase a home for $300,000 and put 10% down. With a 3.5% interest rate, your payment would be $1,476. With a 3.25% interest rate, your payment would be $1,439. That's $37 in monthly savings. Over a 30-year loan, that comes out to $13,320. You can do the math yourself using Bankrate's mortgage calculator.
Adam mentioned that a 740 credit score is typically the ticket to a great rate, but you don't need a perfect credit score to qualify for a mortgage. Let's go over the minimum score you need to buy a home.
Sure. So again, while getting the best deal on a loan from Fannie Mae or Freddie Mac generally requires a 740 or higher, you can still get a mortgage with a lower score. FHA loans and VA loans are available to borrowers with credit scores in the 600s. Both loan programs offer competitive rates, although their fees are a bit steep. Non-qualified mortgage loans are another option. These loans are less restrictive about credit scores, although the trade-off is a higher mortgage rate. Seeking out a mortgage in the early stages of your home search can help you avoid many of the pitfalls that befall first-time buyers.
So we've covered lenders and credit scores. Let's knock out a few more common questions that first-time homebuyers have.
Mortgage points are fees a borrower pays a mortgage lender to trim the interest rate on the loan. This is sometimes called buying down the rate. Each point the borrower buys costs 1% of the mortgage amount. So 1 point on a $350,000 mortgage would cost $3,500. Each point typically lowers the rate by 0.25%. So 1 point would lower a mortgage rate of 4% to 3.75% for the life of the loan. Homebuyers can buy more than 1 point, and even fractions of a point. A half point on a $350,000 mortgage, for example, would cost $1,750 and lower the mortgage rate by 0.125%. How much each point lowers the rate varies among lenders. The rate-reducing power of mortgage points also depends on the type of mortgage loan and the overall interest rate environment. Points are paid at closing and are listed on the loan estimate document, which borrowers receive after they apply for a mortgage, and the closing disclosure, which borrowers receive before the closing of the loan. It's also worth noting that points may be tax deductible. If you plan to keep the loan for many years, the savings from the lower rate could offset the upfront cost. The process is not a snap of a finger, but it's certainly getting faster with the advent of digital lenders. Expect closing a mortgage to take 45 to 60 days, or potentially fewer if you roll with a digital lender. If you're facing a time crunch, there are many lenders who can accelerate the schedule. Documents you may need to collect include a form of identification, like your driver's license or passport, your most recent tax return, a few recent pay stubs, a few recent bank statements, and account statements from your investment accounts. There might be some additional documents needed depending on your lender. This may seem like a lot, but it's really not, and it's 100% worth your time in the end.
Now that you've gathered the things you need for your mortgage, let's dive into the different kinds of mortgages you may want to consider.